Retirement in America is about to see a big shift. President Trump has just signed an executive order that will open the door to new types of investments in retirement plans. For years, 401ks and similar accounts have mostly been limited to stocks, bonds, and mutual funds, investments that are easy to buy, easy to sell, and easy to track. But that's changing. Soon, everyday savers could have access to private companies, real estate projects, infrastructure, commodities, and even cryptocurrency, things that until now were mostly reserved for wealthy investors and giant pension funds. Supporters say this is a huge opportunity to potentially earn bigger returns and protect savings from the ups and downs of the stock market. Critics warn it could bring higher fees, harder to sell investments, and more risk if people jump in without understanding what they're buying. Here's what's really happening. This isn't just a small test run. It's a clear policy shift. Your retirement plan will soon be allowed to include what's called alternative assets. Imagine having a stake in a company like SpaceX before it goes public, or owning part of a commercial real estate development. These investments often behave differently from the stock market, which could mean more stability in rough times. But they also come with a catch. They're expensive and less transparent. A regular mutual fund might cost you around 0.3% in annual fees, but a private equity fund could charge 1 to 2% plus up to 20% of profits. And those are just the obvious fees. There can also be transaction costs, custodial fees, and other charges buried deep in the paperwork. Another difference is liquidity, how quickly you can turn an investment into cash. With stocks, you can usually sell in a couple of days. With private equity or infrastructure projects, you might be locked in for years, with no guarantee you can get your money out early. That's why your age and timeline matter. If you're decades away from retirement, you might be able to ride out ups and downs. But if you're close to retirement, having money tied up in something you can't sell could be a real problem if things go south. The new rules won't kick in right away. The Department of Labor and the SEC have 180 days to set up the regulations, so most people won't see these options until sometime in 2026. And even then, not every employer will offer them. Some may avoid the risk entirely, since there's always the chance of lawsuits if employees lose money in these kinds of investments. But if legal protections are added, more plans will likely start including them. If that happens, many experts suggest limiting alternative investments to just 5 to 10% of your portfolio, so you can benefit from the opportunities without putting too much at risk. And yes, cryptocurrency is on the list of possible options. This is digital money, like Bitcoin and Ethereum, that exists only online and can change in value very quickly. Some people have made fortunes, others have lost huge sums just as fast. It's not backed by a government or protected by the FDIC like your bank account. If the platform holding it gets hacked or goes out of business, your money could be gone. Crypto prices can swing by 50% or more in a year, so it's a high-risk investment that should only be a small part of your plan if you choose to invest in it at all. There are definitely potential benefits. Alternative assets can give you access to parts of the economy you couldn't touch before, like large infrastructure projects or private companies. They might offer steady income from things like real estate rents or utility contracts. They also give you more ways to diversify, so you're not putting all your eggs in the stock market basket. But there are also big challenges: higher costs, limited access to your money, and valuations that might only be updated a few times a year, and based on estimates, not real-time market prices. In the end, this change could help narrow the gap between everyday savers and wealthy investors, but only if people go in with their eyes open. Over the next year, watch for updates from your retirement plan administrator. Read the fine print on any new options, and don't invest in anything you don't fully understand. These decisions could shape your financial security for decades.